But anyways, as you mentioned, let's get on with it. Let's go onto our uh, 2024 preview, which leads into this trade. So we had this narrative where, like I said, people typically use options for protection. Now they're using options to collect some income. That kind of changes the game and kind of changes how options traders like us look at the market, because volatility, is a little bit different. Brian, what are you seeing here?
Yeah, this is an interesting chart you bring up here, and I got to trade off of this because when you look at the market, it's made what we like to call sort of this head and shoulders bottom, where you get what seems to be a market that's making lower lows, and all of a sudden we have this reversal now, and we're seeing higher lows, and now we're sort of breaking through this neckline at the 4,600 mark in the S&P 500 index. When you look at that, it looks like we're starting to break through and break out of it. So typically what I like to do is look at sort of stock replacement ways or ways to own options to play this potential breakout, because I think one of two things happen into 2024 is one, we get a breakout above this 4,600 level, or two, it starts to break out to start the year, and all of a sudden everybody is trying to pile in that trade, and then there's a reversal and people try and back out of that, and all of a sudden this could create some significant selling. Because when I look at sort of this neckline, 4,600 all the way down to 3,500, typically when we fail this kind of breakout, it goes and retests the lows. So there's some risks to the downside here. And I think using a long options position to play this kind of gets into like a market update. A few weeks ago, I laid out a SPY trade of buying a call. It's now significantly in the money. So I'm looking to roll this call and put on a slightly different trade, still using call options, but I'm going to sell out of that call that I once had. Or if I was long the market, let's say I would sell out of my stock position. And I'm looking to sort of keep that delta exposure by buying two at the money calls. And I'm looking at the SPY March 467 calls. I can pay about $10.65. That's where they were trading a couple hours ago. And then that way, I think option premium is so low here. Think about it. This is about a under 4%, about 3% of the value of the SPY. So I'm going to pay that twice. I risk about 6%. I get double the upside now through that break even of, call it 477.65. And then on the downside, I'm only risking the premium I've paid on these calls. So that in itself kind of gives me a protection as a way to sort of replace something I once had that has become 100 delta to the market, like we say, or it has full exposure to the market. I can kind of take that risk away, only risk the premium of the call. Joe,
right. I love this. I love this trade. You're buying two calls that gives you 250 delta calls that gives you the 100 deltas. It gives you that, one-to-one move like stock does. If you got some questions about this trade, we're going to have some education on the stock replacement later in the show. So stay tuned throughout the show. But yeah, that's what we're looking at here. We're looking at two calls, which gives us the same delta as stock, right?
Yeah. And so this is just a smarter way, risk less, to potentially make more if we can get up through that break-even side. Like I said, I think that neckline, 4,600 down to 3,500, the target for me then puts this market, the S&P, north of 5,500. So we could be in for a significant move that would put the SPY above, call it 550.